So I made a 1.22% gain in this stock. This is EMS Limited. Well, I sold the stock too early. I realized that I had made a mistake in this. But now when I look back at the stock, I realized that probably it was not a mistake. Probably I did the right thing by selling the stock. But anyways, let us come back to the chart. Let us look at the whole story. And once I narrate the whole story, you will understand what I'm saying. Okay. So I bought the stock on this day, which is 8th of August. As you can see, high volume breakout there above the yellow line. The yellow line is always my buy price. So if you have been watching my videos by now, you know that the yellow line is my buy price. So this is what I saw on the day before the breakout. Now, in this case, I have violated some of the rules that I use, but I will tell you why I violated my own rules. Okay. Sometimes, from a risk management point of view, even if I make a wrong decision, from a risk management point of view, it might be a right decision. So, let me explain what is happening here. So, if I put the moving averages, see 50-day moving average, which is the blue line, is above the 150-day moving average, which is the green line, which is above the 200-day moving average, that is the red line. So I have the blue, green, red combination, which is a basic characteristic of a strong uptrending stage 2 stock. Okay, so I only want to put my money in stage 2 stocks. This is one of the reasons I uh, selected this stock for purchase. But that's not the only reason. Let me show you some other reasons. You see this nice base formation here, stock goes up, then it starts to consolidate. Okay, so if I draw the base for you, looks like this: point 1, point 2, point 3, point 4. So there are minimum 4 points in the base. My criteria, basic criteria, is I need minimum 4 points in the base. 4 points means two contractions or two corrections. Okay, which you see here. This is the first correction, this is the second correction. So I have two corrections in the base. The third criteria that I look for is there should be minimum 10 candles in the base. Now, in this case, this candle completes point 1. So I start counting from this candle. So 1, 2, 3, 4, 5, 6, 7. Okay. So my basic criteria is I want 10 candles in the base. 10 candles means 2 weeks of consolidation. But in this case, I have only 7 candles. So why did I buy the stock? The only reason I bought the stock is because of very high relative strength. I remember when I bought this stock, it had a relative strength of almost 94. Okay. What do I mean by 94 relative strength? 94 relative strength means this stock, EMS Limited, has done better than 94% of all the stocks in the Indian stock market based on a 52-week price performance. Or, in other words, I would say that the 52-week performance of this stock is better than 94% of all the stocks in the Indian stock market, irrespective of their industry. Okay. So it's a very high relative strength stock. So that is why it was a very big plus. It got me interested, but there are some negatives here. There are no 10 candles in the base. So I'm buying it very prematurely, number one. Number two, after point 2, there is not a single candle that has closed in the blue zone or the green zone. So this is a very risky purchase. I am buying it I am buying it at a very lower, at in the almost the lower half of the base. Okay, there is no price action in the upper half. The red zone is the lower half, and above the red zone you have the green zone, which is the first quarter, and the blue zone, which is the second quarter of the base. So none of the candles has above after point 2 has closed above the red zone. That's a negative sign. Okay, that's a dangerous position to get into a stock. It's too early. If the stock does not break out on high volume, there is a good chance that the base or the buy point might fail. So I was waiting for high volume, which I got on that day. Okay, so if you see here, if I move it, sorry, let's go one candle ahead. See, let me reduce this. Yeah, now it's perfect. See this high volume breakout. Okay, the only concern on this day was that long upper shadow. The longer the upper shadow, the more bearish is the stock. The longer the lower shadow, the more bullish is the stock. So, although this stock broke out, closed above the yellow line, I was already in profit because I had placed a automatic buy order on the yellow line with a 2.5% position size. Okay. So, I controlled my risk here with the position size because I knew that just having relative strength is not enough. The stock should have a proper resting period, and even on the breakout day I need very high volume on the breakout day if I am taking unnecessary risk. So it doesn't have 10 candles in the base, it has no closing in the blue zone or the green zone, two big risk factors. Okay, if I am up against two big risk factors, I better need good volume on the breakout day, which I got, by the way. This is like swimming against the flow of the river. Okay. So that is why I needed that force, which I got on that day. And I was happy because I was making money. So the stock closed higher above my yellow line. Then look what happens. Next day, the stock gaps up and then closes near the close of the previous uh, candles close. So this is in Japanese candlesticks terminology. This is called as a bearish counter attack, if I remember correctly. But I don't want to discuss candlesticks in this video because candlesticks is a very vast subject. You can check my Udemy channel. There are 20 courses I have made on candlesticks. But here, I don't want to get into candlesticks. Here you can see on this day, stock opened up higher but closed near the close of the previous day. But it was still higher, 0.16% higher than the previous day close on low volume. Okay. So red candle on a low volume. What does that mean? It means that the institutions are not selling. If it was a red candle, and if institutions were dumping the stock will never close 0.16% above the previous day close. So it's a sign that although the candle is red, but I don't see any institutions getting rid of the stock. So I decided to stay in the stock. Next, look what happens. The stock shoots up. As I said, there was no institutional selling on this day. And then again, the institutions came back into the stock with heavy volume. This was 2.2 million volume shares traded on that day. However, on this day, there was a problem. The problem was I was looking at my entire portfolio. There were five stocks in my portfolio. If I remember, one was EMS, second was Zomato, third was Servotech, fourth was, I think, TD Power. I don't remember correctly, but there were five stocks in my portfolio, and I was having a good gain. I was having a gain on each of those stocks. Okay, so I looked at the unrealized gain, and then I looked at the realized gain, my recent realized gain, recent 1 month realized gain. So I looked at the unrealized gain. I said to myself, if I sell all my portfolio now, if I just liquidate all of my stocks, how much will my realized gain go up? And I realized that my realized gain will shoot up 50% if I just liquidate my whole portfolio. If I simply convert my unrealized gains into realized, my realized gain would shoot up by 50%. That was very encouraging for me. So I decided to just clean up the entire portfolio in a single shot. Okay. Sometimes for risk management, we have to do such things because we are swing traders. We are not professional. Sorry, we are not positional traders. Okay. You can take a position in a stock and stay as long as it remains above the 50-day moving average. But sometimes if you're planning to take big positions in the future, you need money to finance that risk. Okay. And this is the best way to finance risk. The more money we accumulate, the more profits we accumulate, the more unrealized gain we convert to realized gain, the more risk that we can afford in the future. Smaller number of stocks, but a bigger position size. That's the real goal, right? Can I take a 20-25% position in a stock? Okay. And can I afford the risk on that stock? For that, I need realized gains. Okay. So if that is the purpose, then the selling decision becomes very easy. So I ended up booking 1.22% on this stock, not much. Okay. I sold somewhere here, somewhere in the lower shadow, I ended up selling. So I sold too early. As you can see, the stock was going up nicely. This candle has closed outside the base. Okay, that's very encouraging. So I should not have sold the stock. I have sold the stock very early, looking at this candle. However, now when I look at the stock, a few days have passed. See, it has started to come down below the yellow line. Although the volume is less, so the institutions are not selling, but there is no price action. That's probably because this was a premature buy point. Okay, although the relative strength of the stock was very high, but as I continue to tell again and again that I need 10 candles in the base, I need minimum 2 weeks of consolidation in the base for me to have that confidence. Already you can see that I was not confident about this stock because there were just too many negatives. Okay. So if I have a big number of negative factors weighing in on the stock, I can control my risk either with position sizing or by getting rid of the stock early before it starts eating into my capital. So that is how I managed this position. So if you have any questions about this particular purchase and why I got out early, let us discuss them in the comment section, and don't forget to like, comment, or subscribe. This will help me to reach more like-minded people who want to become professional traders just like you. Thank you so much.